All right, everybody, this is being recorded. Something I mentioned at the beginning of every single webinar is watch this again. The reason why is if you watch it again relatively soon after me putting this out there, you watch it through one time, watch it through again, because it'll sink into your long-term memory. First time through, especially if you're a newer trader, you might miss some of the nuances that we're going to be talking about. Second time through, you'll remember it. It'll make a little bit more sense. And that long-term memory kicks into effect. So you're not going to be like trying to learn it all over again if you wait too long down the road. All right. So this is a new course that we're building out. So there might be some kinks. You're going to have to deal with me. But give me some feedback. And I'm always looking forward to any kind of feedback. This is our roadmap to trading options. And we're going to start out. Yes, it is on the long call, but I want you guys to kind of put that in the back of your mind, as that's not the first thing we think of when we're going to trade options, right? Hey, I've got to put on a long call today. What we usually do is we come up with like an assumption around a given underlying, and then we need to find out what option is best for that situation, which is what we're going to try to do with this particular webinar and go through it that way, okay? Just trying to get a couple of things set up here. All right, so this is going to be on the long call, but let's put that in the back of our mind. Let me go over a couple of things real quick, though. My name is Eric Wilkinson. Yes, you very well may recognize me from mainstream media, where I've talked about everything from economic and geopolitical and how that affects the market analysis. Well, I do the same thing in and around my daily market commentaries. But in these webinars, I drill down on these different option components that I'm implementing into my portfolio on every single day. So this is kind of how I go about it on any given day when I come up with a directional assumption based on that economic and geopolitical environments. All right. I've started out trading in college with some money I had earned, moved to Chicago there closely after, and started working on the floor as one of these runners. And then I moved up into the pits, and in that entire time till now, I've been trading everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. Also, you can follow me on Twitter at Wolfman's blog. You can also follow our parent company at ProTraderStrat. And our Facebook page is ProTraderStrategies.com. That's where we're throwing out a lot of content from Steve Primo to myself. I do daily market commentaries, and we're going to be starting to do some interviews. So you can also reach out to us and give us some ideas of people you would like us to see interviewed on any given daily basis, where we're going to talk about, hey, you know, how does your daily process go? What do you do on to get ready in the morning before the markets open? Things of that nature, and some other fun content. So check us out on ProTraderStrategies.com, that Facebook page. We'll get a lot of good content out to you guys. All right. Also, switch the page here. This is the long call, but again, I want you to kind of forget about that for the minute. What we want to do is, first thing we do is, where are we going on this roadmap, right? We've got a journey ahead of us. Where are we going? Well, in this idea, what we're going to be looking at is, say, for instance, we're starting out here. We're going to say, all right, I'm going to throw it out there. IBM is where we're going, right? We've got IBM in mind. And for lack of a better underlying, I'm using IBM just to kind of get us through this. Let's just say we came up with IBM and we started talking about where we think IBM is starting to go. We have got a pretty good idea. First thing we think of is, what is our assumption with this one? Well, right now, let's just say IBM, I have a bullish assumption. Keep in mind that we're putting that long call in the back of our mind right now. Yes, you know where we're going with this, but we've got a bullish assumption in IBM. So the idea is, like we talked about, we've got IBM over here. So that's where we're going. Not a very good B. And let's just say we're starting out here somewhere about Chicago. All right, we've got a bullish assumption. So obviously, we want the market to go up. So we're going to take that high road to IBM. The next thing we have to think about is, what is, since we have a bullish assumption, we know we're going to be looking at IBM, what is that environment around IBM right now? Okay, we've come up with this bullish assumption on it. We need to understand what that environment is around IBM. When I'm talking about the environment, you know, if we're looking at a roadmap, I'm talking about volatility. What is volatility? Is it low, or is the volatility high for IBM? Think about it that way, right? If it's low, we've got sunny skies. There's nothing out there that's going to really affect us going forward. There's nothing that, you know, is going to be a weather situation that could cause us a delay or something like that. Whereas if it's rainy, we can think of that as high volatility, right? The stress level is a little bit higher when it's rainy and you're driving out to IBM land. So right now, what we're going to be looking at is low volatility. IBM, we know, has low volatility, right? So if it has low volatility, then we need to know, why does volatility really matter? Well, volatility really matters because if there's a lot of volatility, it pumps up the premiums in the underlyings. Also, like I mentioned, if there's high volatility, then that's going to cause more risks that are in and around that underlying. Right now, we know we have low volatility, so therefore, it means that we can take some more side roads, take a little bit more time. We can go and see the cheese. There's a cheese palace right here in Wisconsin. As we would going north, you start heading further out, we could visit something like the Corn Palace, which is in Minnesota. I've been there, and it's actually a big, huge theater, and they line the outside and inside of this building with corn, like Indian corn, and they build these mosaics with corn cobs and the different colors of corns that are out there. You can go out a little bit further, and you can hit Wall Drug, which is out there by Sturgis, if you've ever heard of Sturgis, or the big biker rallies are out there. And further, you could take your time and go and see Yellowstone, which is right in and around there. If you ever go to Yellowstone, the best way to go into Yellowstone, just so you know, is from the northern end there. So we know we're going out to IBM. We know we have low volatility, right? And so therefore, we can kind of take some little road trips, right? We can kind of go off the beaten path and just take our time getting out there. Well, that's the duration with low volatility, is that we want long duration. We got a long time to get there. We can see all these different sites. So you want to give yourself a little bit more time when you're dealing with low volatility, all right? They kind of go hand in hand, right? High volatility, you want to beeline out there, right? You want to get there as quickly as you can. So you're picking shorter duration usually when you have high volatility, because that's where we would be looking towards selling premium. We got low volatility. We want longer duration because we're going to be looking to be buying these different options, all right? So duration, we want a little bit longer. Volatility affects those prices of premiums, like I mentioned. If volatility is high, we want to be selling it. If volatility is low, we want to be buying it. We've already determined right now that volatility in IBM, which I could pull up, IBM has low volatility. We know that. If we have low volatility, that means we're usually going to be buying premium. And if we're buying premium, we want that theta decay to be at a very near low, or very near, or at a very low point. So when we're buying an option, a trader wants to limit that theta decay. We already know volatility is low. That means the price of those options are really cheap. So we're going to be leaning towards buying. If we're going to be buying these options, we want to pay as little as we can for them, right? I mean, we don't want to pay when volatility is high and those premiums are jacked full of premium. That's where you're just paying up too much, right? And when that volatility comes out, when you're paying up for that premium, it can hurt you despite the fact that you're directionally right. If you're buying premium when volatility is really low, you know you're getting those options premium about as cheap as they can be. And if volatility expands, that can help us. And the likelihood is that when volatility is super low, it's probably going to start going back up. As we can see here, I'll pull up a platform just to give us a little bit of an idea as to what I'm talking about here. So when we're talking about volatility, let's just pull up IBM for our example, IBM, whatever that other thing was. And let's go over to the chart. So when we're talking about implied volatility, I'm talking about, pull up a chart like this, implied volatility for itself. Every underlying has its own coefficient of implied volatility here. My charts are not legible. Can you guys not see this here? How about now? So right down here at the bottom, you can see I got a chart of implied volatility. So what we need to determine is, what is 30? Is that high or low implied volatility for IBM itself? If you just are looking at implied volatility over on your trading platform in the option montage, and if you ever hear me talking about option montage, this is what I'm talking about. We're looking at the Vega, and 30 over here doesn't mean anything, right? We have to put it into perspective as to where IBM's implied volatility usually is, okay? Because if we looked at something like Tesla, you know, Tesla is going to have a completely different number here. It's 66. But what does that mean? It means that 66 is probably pretty high for IBM, but what does it mean for Tesla? It could mean that it's actually pretty low in comparison to the type of volatility we've seen recently. So 66 for Tesla is about the same as what we would see for something like IBM. As a matter of fact, current implied volatility percent for Tesla is 19, and for IBM, it's probably around 18. So there you go. There's my point. My point's proven there by the fact that 30 for IBM is basically in the 18th percentile of where it's been the past 52 weeks, all right? And Tesla, a 60, is right around that same implied volatility percent for the last 52 weeks. So implied volatility percent just tells us that this is, you know, in the 18th percentile. Obviously, when Tesla was trading up here, or sorry, IBM was trading up here, that was at the 100th percentile. When it's trading, when IBM is down around 16, that's at basically 0. That's as low as it really normally gets. You know, 18 could be a very high for like a utility or something like that, or some ETFs and stuff. So keep that in mind, that when we are looking at this implied volatility number, specifically that number, that doesn't really tell us anything. What we need to do is put that in relation to where this underlying has experienced volatility in the past, okay? Implied volatility is forward-looking, but we need to look at its expectations of future volatility, which is why I like it. But the thing is it usually has a pretty good range-bound metric that we can go off of. It usually doesn't spike too far out of the normal range. You know, obviously, we've just gone through a black swan event, and we've seen volatility really spike. Can you make the chart full screen? Are we talking about this implied volatility one? Whoops. You're talking about the implied volatility. I'm just kind of going off of that. I can try and drag this up a little bit, give it a little bit more color. Is that better for you? So when we're looking at implied volatility, we need to know where it's been in the past and where it is currently. And one of the things that we look at this for is coming up with that relationship, all right? So theta decay, we've talked about that. Theta decay, we want to limit that. So if I go back to this platform again, and we look at theta decay, one thing to know about theta is it's the thief in the night that comes and steals your premiums, you guys. That's what we used to say on the floor. Theta is the thief in the night. And if that helps you remember it, that's what you should go with. Theta is the thief. And the reason we call him the thief is the closer and closer to expiration, we can see right here, theta is a negative coefficient on both the calls and the puts. So the closer to expiration, this number starts getting bigger. And the reason why it's negative is because you can't go back in time, right? Nobody has a DeLorean that goes 88 miles an hour and all of a sudden you're back in 1920. Well, what happens here is every day that goes by, these premiums decrease by that 8 cents. And if I go further out in time, we'll be able to see that, say it's 78 days, you can see that the theta coefficient is half of that, all right? So the closer you get to expiration, that theta starts really eating or eroding away at your premium. Now, so we want to get further out, right? If we're buying something, we don't want to see that theta come and start picking away at our premiums right away. We want to limit that. Now, you can't get rid of theta, all right? You can offset it when volatility starts expanding a little bit. That will help offset it, but you can't get rid of it because you can't stop time. And as time goes on, that theta coefficient starts eroding away at our premium. So when we're looking at low volatility, we know we have cheap premium, right? And therefore, if we want to buy something cheap, that means we're leaning towards the buy side. That means we got to be looking at those calls that are further out in time. The duration is further. Now, I'm not necessarily saying we go out 2 years into January 2022 because most of our time horizon on this trade is probably the next couple of weeks or so, right? We're probably looking maybe 3-4 weeks on a given, just for a trade. Now, I'm not talking about a long-term trade here. I'm basically, we've got a market set up. We're looking at the Fibonacci's. We've got a buy signal somewhere on IBM. So we start digging into that thesis of our bullish assumption and what is the right option strategy for that. So as we go through this progression, the first thing we do is look at IBM. Is it a tradable contract? And I got a little ahead of myself. What we want to look at during open market operations is the spot month for IBM. And this is after the close, so the markets have gotten a little bit wider. But my rule for this is on a stock that is over $100, then we want to look at it as like red light, green light, and all of that stuff. So basically, if I come up here and I pull up a stop sign or like a light, all right? So we've got the lights here. On a stock that's over $100, we move the decimal 3 ticks to the left. So we're going to be looking at somewhere around 13 cents, all right? So in the closest to 35 days to expiration, that's usually the spot month. People are going to be moving out of this month here and rolling out into that 43 days very shortly. So there's going to be more volume and open interest. That's where free market price discovery is really in full swing. So that's where most of the eyeballs are going to be. And remember, when free market price discovery is in full swing, it means you and I are bidding back and forth. If I come in and I offer something a little bit better than you, you might, leapfrog me and offer, if I'm offering it at 150, then you come in and say, hey, I'm at 149 or something like that on the pricing. You step in front of me. That's free market price discovery. And then the bid person might start stepping up the bid a little bit, trying to find that middle ground where we will meet as buyer and seller, okay? And having said that, never go and just hit the bid or lift the offer really unless you really, really want to get in right now, all right? Because you might be able to get it a little bit better. And I'm not saying put it in there and wait for like 30 minutes or something. I'm saying, if I were to come into this market right here, and I wanted to offer it, I'd come in and step in front of that guy and offer it at 214, right? And then see if I get a better bid and see if somebody comes in 203 bid or something like that. And then, if I stepped in front of your 215 bid, you might go, hey, I'm at 213. So the idea is if there's a lot of eyeballs in there, they're going to start bettering the market. We're going to kind of fall over each other in order to represent our market, our market on the bid or the offer. So we're looking at 35 days to expiration or as close to it as we can get. And so in IBM, if it is equal to or less than, so I'm just going to say if it's equal to or less than 13 cents here, down here in the option montage, when we're looking over here at these or over in the puts that are just out of the money, then that would be a green light. So less than or equal to 13 cents is a green light. A yellow light would be if it is basically 2 times the rule. All right. So the rule is 13 cents. So like 26 cents starts making it a yellow light. And we're after the close here. You can see that it's inside of at least a yellow light here. It's just an idea to get you guys knowing that there is a lot of participation in the particular underlying you're looking at, because there's stocks out there that everybody has heard of. We could say like AutoZone or Aon. Those are names that everybody's heard of, but nobody trades Aon for some reason in the option. Yeah, they still get the same probably volume as IBM, 3 million, 4 million contracts on a given day, but nobody goes over and correlate or starts trading the options around that. So Aon might be very wide in relation to IBM or something along those lines. So that's the rule for something that is over $100, and if it's 3 times the rule, then I would say I wouldn't want to go in there and start trading those. Okay. And then if we're going to go over and look at something else where it is under $100, let's just take a look at we can look at eBay. So if it's less than $100 stock, then my rule here is for this stop sign idea or stoplight idea, right, is that if it is less than or equal to 10 cents wide, then that's a green light. Obviously, then same thing goes where if we're looking at 2 times the rule, that is a yellow light. And if it's 3 times the rule, especially in regards to a stock that is under $100, I would just say don't trade options around it, okay? And this is for a stock that is less than $100 stock, okay? So when you're looking at XYZ, if XYZ is less than $100 stock, go to this idea. If it's less than or equal to 10 cents, then that's a green light. Those are tradable options for that particular underlying. 2 times the rule, especially on under $100 stock, we're going to get kind of iffy on it, all right? So if it's 3 times the rule, this is specific to newer traders, to options. All right, this will give you an idea. All right, you know what? I'm newer to options. I don't want to have to do all this price discovery. I don't want to give up too much edge. And therefore, I'm going to kind of stick to that. Any rules regarding the liquidity of the options or open interest? Yes, that's, MS, that's probably how I should have put it, to be quite honest. This is rules regarding the liquidity. You can go over and look at volume and open interest. Usually what you're going to see here in something like eBay, when it fits those rules, or at least fits the rule for a minimum of 2 times that, is that when you go over and look at the volume and open interest, you're going to see there is pretty good volume and open interest going on with eBay. And if we were to look over there at IBM, IBM's way down at the bottom at this point, so I'll just type it in. IBM, you can see good open interest, pretty good volume going on in there. If you looked at something like Apple, it's a $300 stock, move the decimal 3 ticks to the left, right? So 30 cents between the bid offer. All right, right now it's after the close. Think about it. When you guys hear that bell ring, especially if you're on TD Ameritrade, you can hear like ding, 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 ding. Everything's getting canceled. Like all of those orders kind of go into the cancel column and they get pulled off. So it's not being represented in the market anymore. And therefore, the market starts getting a little bit wider. But you can see here, it's still pretty darn close to that 30 cents for a lot of these options. This one's a little bit wider. It's 50 cents wide, but the rest of them are pretty darn close to that rule. So Apple, obviously a green light to trade options. There's all kinds of volume and open interest going on in Apple on any given day, which is why you see that kind of volume and open interest going on. It's because all of these eyeballs are on it. We all have open interest, or there's a lot of open interest, which means you have contracts that you have either purchased or sold, and you are very interested in keeping an eye on it. So you're constantly going over there and checking it and stuff like that, especially if you have a working order. If you have a working order in there and somebody, betters your offer or betters your bid, you start making those adjustments. That's where I'm talking about the eyeballs on the market. And so my rule, MS, kind of is in line with that volume and open interest. If they're tight and they fit that rule, especially on a green light, that means there's a lot of open interest in there, or at least a lot of interest, right? There's a lot of eyeballs on there trying to make that bid offer. Free market price discovery is in full swing. And that's what's making those markets a little bit tighter there. All right, so that's on the right underlying, right? Then we talked about theta decay. We can see that theta decay, even here, get back to my theta here, you can see that theta for Apple, or let's go back to IBM because that was our example I wanted to use. IBM, and just to keep it consistent, you can see even further out here, the theta decay is still only 4 cents, but it's going to start ramping up. As closer we get, we can see that now it's 8 cents. So 45 days, I like to go outside of 45 days to expiration, because if we go and look at what theta decay does, I've got my platform up. So theta decay, this is a representation of the at the money, and actually with my rules on this particular strategy, we are going to be using very close to the at the monies. So the at the money call and put here is particularly important here. Let me get rid of my highlighter. So right now we're just inside of like this area here, right? So you can see that theta really starts picking up, and 35 days to expiration is really when that thief starts going ballistic and starts picking up the pace. And we can see that the premiums drop quite dramatically within 35 days to expiration. So we've talked about this since the beginning, right? We're looking at IBM, has low implied volatility, right? And that's making us lean towards, and we've got a bullish assumption, we already know that, that's making us lean towards buying options. So if we're leaning towards buying options because of that low volatility, we want to get out here in time. So, we want to be out in this area here, where if we're only in it for a couple of weeks, right, we're basically probably going to be out before that theta really starts ramping up. And it gives us a little bit of wiggle room, a little bit more wiggle room to be right as well. So we want to get further out in time. So we want to avoid this theta decay. All right, we want to stay away from that as much as possible, and get out in time to where we start seeing a green area. All right, so that's where we want to be. I see a question popping up. Let me just get over that one. Looking good on the diet is working. Sorry, I'm late. I'm not on a diet. Well, I've been on a diet for 3 years. I actually completely got out of my habit of exercise and everything else when I moved to Arizona, and I found In-N-Out Burger on a weekly basis. So I did let myself go for a little while there. When you say IB, do you mean IB percentile? Yes. When I'm talking about and implied volatility, I want to specifically talk about implied volatility. So, and say implied volatility, because I don't want people to misunderstand that I'm talking about the VIX. All right. Yeah, I keep an eye on the VIX. But does this really determine if I'm buying or selling options premiums? Well, no, it doesn't. It does give me an idea as to what volatility is across the spectrum, right? But it doesn't tell me if IBM is experiencing high volatility right now, right? So that's why we look at that chart at the bottom there. When I was looking at, say, for instance, IBM, hopefully I've got a chart up. when I'm talking about IBM here, and I'll make it a little bit bigger. If this is the right one, there we go. That we want to look at implied volatility. And when I say percentile, that's the idea as we're coming up with that relationship. So a little bit more about implied volatility percentile. The way this is generated, when I was looking at this and we saw that it was an 18%, right? What happens is we take where the current implied volatility is, you take current implied volatility, IV, all right, I'm just going to say that, and you subtract that by the low IV, and you take that sum, all right, that sum, and divide it by the high IV minus the low IV. All right. So basically what we're looking at here, and I'm just going to kind of ballpark it, the current IV right now is 30. So in this one we got 30, and if my memory serves me right, we came up with like an 18 for the low IV when we were going through that. So I take that sum and divide it by the high IV, which was 100, minus the low IV, which was 18. And then we take that sum, which is 12, divided by, what is that, 82. 12 divided by 82. So that puts us, 82 goes into, that's right around, that's saying it's right around 20, right? With my math, that's probably off by a little bit, but the idea is that I probably could pull up a calculator, but won't let me do it right now. Somebody else could do it. Wait. Oh, 14. Yeah, you're right. Yeah, because 82 goes into 120 one time, and then that leaves us with about 36. So that goes in, 82 goes into 36 about 4 times. So that's right. 14%. Thank you, Alexander. 14%. So that's a little bit lower than what we were getting. 18% was what TD Ameritrade would do. So off the back of the napkin math, go with what TD Ameritrade says. But, we were also rounding. We're not going to the decimal like they are there either. But the idea is that is basically saying we're in the lower quadrant here, all right? And my rule for this is anything above 50, we're basically selling premium. Anything below 50, we're buying premium. Now, we do have something here which is going to be considered a black swan event, all right? And we're going to have to keep an eye on this. We could see more spikes in it. We haven't decided whether or not this can be discounted because, black swan events only happen once every 5, maybe even 10 years, right? So that volatility spike might not be seen again for IBM for the next 10 years or so. So we're going to have to keep an eye on it, but we still need more data to understand whether or not, the VIX 40 is the new 20, whereas the past probably 5 years, when we got up into the 20s in the VIX, that seemed pretty high. Well, right now we're kind of still in the 20s. So that's relatively low for what we've seen. So we're going to have to keep this in our data set for right now because, unless you completely believe that there is not going to see that kind of volatility again, then you'd want to discount it, right? And then you would probably go with something like, maybe this being the high area. You could say, okay, well, that's high volatility now. And if you said that was high volatility and this is still low volatility, it's not a very good line, but you guys get my understanding there, right? Then you would come up with your math based on those parameters, right? That could say that then IBM has a higher volatility percent if we discounted that spike there. I'm not ready to do that just yet because I don't know that we're out of the woods yet. So I'm going to leave in those spikes because we could very well see some more volatility down the road there. Okay? That makes sense so far? So basically you want to exit the call when you reach 35 days before the expiration. Not necessarily. You know, I would obviously in a perfect world, then yes, we would. But if this strategy is really working out, and you know, let's say for instance the market's moving clicks higher, say $1 a day. Well, think about that. Then you know, those couple of pennies aren't really going to hurt us. Now, obviously, if it's just trending sideways, right? We got that bullish move, and now we're inside of that 35 days, and it's starting to settle down. Then yeah, I'd probably cover this trade, because then it's going to start eating away at my premiums. But remember, every day that goes by, and we're in this one here, let's say we start getting inside of this wheelhouse where the theta starts picking up. Keep in mind, for every dollar move higher in the underlying, delta affects the premium. So delta, and I was going to throw this out there, and maybe I'll do that for the next webinar where we go through some of those option basics to keep in mind, to just you know, put it into perspective. I was thinking about doing it as, you know, these are the road signs we need to know, and the road signs being delta, gamma, theta, vega. All right, you know, those are the road signs, whether it's a stop sign or something like that. I was thinking about doing that, but I didn't. But delta is right here. So delta tells us for every dollar move higher in IBM. So delta is for every dollar in IBM, it moves from 128.89 to 129.89. Okay. So when we move that $1 higher, so the first dollar move, okay, delta increases our premiums by that corresponding amount. So if we got that dollar move higher, then we would see that, let's say the 130 strike here would increase by 46 cents. All right. So it would go from, let's just go mid dollar, right? $4 mid market to $4.46. That's if nothing else changed. You know, we didn't get the theta component, but we just got $1 increase in that underlying. That $1 increase in that underlying increases the value of that option premium by delta. Okay, that's the first dollar move. Second dollar move is gamma, and I wrote over it. So that's, you know, now we're at 130.89. So the second dollar move, right? We talked about, I'll throw it over here, the 130 calls, you know, are now on the first dollar move. Sorry, I'm trying to think through this. That first dollar move higher, those 130 calls went to $4 and what did I say, 46 cents, right? So that after that first dollar move, they're at $1 or $4 mid market and 46 cents. Now we're looking at the second dollar. So now it's moved up $2. Nothing else has changed. Now gamma goes with delta. So gamma is over here. Gamma goes with delta. So now the next dollar move higher, it adds in 49 cents because it's 3 plus the 46 from the delta is 46. Gamma goes with delta. So 3 cents goes into it. So on that second dollar move higher, then our premium would then be 46 plus 49. And we are looking at $4.95, right? So on that second dollar move, gamma goes with delta and it increases by that corresponding amount. All right, that's a way to figure out how option premium is happening. So if you're getting those incremental moves higher, you know, this 5 cents tomorrow coming out of this, you know, tomorrow, the next day, let me try and throw this, the next day, you know, and it doesn't move anywhere after that $2 move higher, then we're looking at $4.90. So yes, it did downtick a little bit, but are we worried about that nickel when we're getting like, you know, dollar increases higher? So it's something you're going to have to keep in mind. If it was just trading sideways, then yes, I would probably look to cover that. Very long explanation for that, D, but you got that. Very helpful. All right, great. Thank you. All right. Is it different when trading things like the QQQs, the RTFs or XLK? Basically, what Beverly's saying is it different when we're trading ETFs? And yes, only in implied volatility though, okay? Because an ETF is a basket of goods where we've got, I think the minimum you can have in an ETF is like 24 underlyings. So if it's an ETF and it's got 24 underlyings, and you heard me talk about that volatility being different for all of them, well, it melds each other out, all right? So my rule for that volatility or implied volatility percent for an ETF, now we're going back to this, all right? So we're taking a step back here. But implied volatility percent for, let's say, a stock, right? And I was going to do this over, but we buy when it's less than 50%, right? And then we sell when it's greater than 50%, right? That's for a stock. Now for an ETF, so if it's an ETF, we buy when it's less than or equal to, usually I just say less than 30%, all right? And sell when it's greater than 30%. Because yes, you will see spikes in ETFs and they will go up to 100%, but it has a tendency to limit those spikes, all right? Usually if there's a spike in an underlying, it's not going to affect the overall ETF that much, all right? So you're definitely buying below 30%. And if you're newer to options, if you're relatively newer to options, I have no problem saying, all right, you only sell when it's above 50%, all right? You know, and when it's in between there, you kind of, you do synthetic longs or synthetic shorts, which I'll do later down the road here in this course. I'm not going to go into all of that, but synthetics are a great way to neutralize volatility. So if you're really unsure about volatility, you could look at that. It's a little bit more high risk than this though. What about options on indexes like the SPX? Well, the SPX is an ETF. So it's an index, but it's still an ETF. It has all of the underlyings in the SPOOs or the E-mini or the S&P 500. Okay. It's just the big dog. It's, you know, the difference between the SPY and the SPX is a decimal point move, right? So if you're trading, you know, SPY, then, and you're doing 10 lots, you know, you should definitely be looking at the SPX to lower those overall commissions, just as a complete side note there. All right, so this is the IV percent rule though for these, okay? Which I was gonna go over here a little bit more in detail here in a minute, but you guys drive the content here. I wanna make sure everybody is clear of concept before we move on. So I love the questions. I wanna make sure you guys are on board with that. All right, so what vehicle do we use? We kind of already talked about this. This is where I talked about, hey, we put this in the back of our mind, what we're gonna do. We talked about this, right? We've got low volatility. We've got a bullish assumption. Well, if it's a bullish assumption, we know we need a bullish strategy. We got low volatility. We know we are going to be looking to buy because we want to buy it when volatility is cheap. You know, you could also think of when you're buying premiums, you're buying volatility in a sense. And when it's expensive, you're selling volatility with the expectations it's coming out. You know, when it's extremely low, even in those IBM, you can see that when it's extremely low, it has a tendency to start ramping up. So even in a situation like this, had I bought, like, let's say I bought calls in IBM, right? And it's starting to trade sideways. But if I look down here, if I look down here at the volatility ramping up, and we'll do an example here real quick. Look, it went from 34 here all the way over here. We're still trading 34, all right? So we've had, what, 2-3 weeks in there where it didn't go anywhere. But now if I go back here and look at volatility, right? So volatility went from 14 up to 27. So it increased by 13 percentage points, let's say. All right, 13 percentage points. All right, we've got that. And it's not going to be apples to apples perfectly, but volatility right here isn't at 14, but it's at 30. But what volatility, implied volatility tells us over here, every 1% point increase in volatility, the premiums goes up by the corresponding number. And volatility affects further duration options more than nearer duration. So we can see here, another reason why we want to get out in time to take advantage of volatility as well is look, the Vega, 43 days to expiration, that 1% point increase in volatility only affects these premiums in the puts and these premiums in the calls by about 18 cents, the ones that are at the money, the ones we're going to be talking about. But if I go out in time, look at this. Those same options are 24 cents for every 1 percentage point increase. We just talked about a 13 percentage point increase over that duration, right? That means the underlying traded completely sideways, didn't increase by $1. So, you might think, this option strategy isn't working out very well. I bought those calls and I didn't get my directional move. But in the meantime, it increased by 13 percentage points. Well, what's 13 times 24? A little better than $3, right? So our premiums would have increased by $3. The underlying didn't go anywhere. But because we set ourselves up for the right strategy, we're buying low, cheap premium, that volatility started ratcheting up, it helps us. That's why I always talk about, like, you set these strategies up. You go online, you guys, and they tell you, yeah, you go out and you buy a call. All right, well, whatever. They don't talk about volatility and where it needs to be. And the reason why is because they don't understand it. They don't understand that you can be directionally wrong with options trading or directionally, challenged and still make money. So in that case, yes, I did cherry pick a perfect area where it was trading sideways and we saw that volatility increase, but that's the idea, vice versa. If you would have sold those premiums, that would have hurt you. So you don't want to sell when it's really low. You want to buy it when it's really cheap with the expectation that volatility is going to increase. Because when volatility gets at those extreme levels, it has a tendency to revert back to the mean. And when I'm talking about the mean, that means 50 IV%, right? That's why I draw that line of delineation above 50 and below 50, because it wants to migrate back to 50, right? Does that make sense? So that's another reason why we want to get that long duration. When we're buying options with low volatility, we can take advantage of this volatility expansion. It goes from 33 to 46. Well, and it's still trading 128, 129 area. Well, I missed the directional move, but all of a sudden this volatility expansion helped me out. I still made $2, $3, right? So that's another reason why to get into that, low volatility. So all of those things that we've talked about there, and I saw a couple of questions buy up. Wow, the light bulb just went off when you said buying and selling volatility. All right, good. I'm glad. So, that's another thing. You guys worked that out of me. I like buying calls 45 days before earnings. Yes, because usually the idea there is what MS is saying, if you're buying options, calls or puts for that matter, 45 days to expiration, or not expiration, 45 days before the earnings cycle, we can see that coming into going back to cherry picking again, you can see heading in, one of the reasons why this volatility was expanding going into that time was that it was heading into earnings. All right. But don't hold it if you're doing something like that. This would be it traded sideways. I got that volatility expansion. I probably had a winning trade on there. I would probably cover that trade before that earnings event. All right. Because you can see what happens with volatility after that earnings event, right? That would be disastrous, even if it traded sideways. That's where you would be long volatility and the floor or the rug just got pulled out from underneath it. It could have still stayed right there. It didn't even move. In this case it did, but if it didn't even move, all of that volatility comes out, and that's the situation where you would have been wanting to be short volatility, especially when you know volatility is going to come out. One of the few times we know volatility is going to come out is right after an earnings event. It almost never expands. Yes, sometimes it will, but the idea here is more times than not, many more times than not. I'd say probably, I'm not going to throw a percentage out there because I don't know the exact percentages, but rest assured, volatility comes out after an earnings event, unless the earnings call goes off and the whoever's doing the earnings call says something really silly. But you can see even here, volatility comes out after the earnings. So in this case, if you were long calls going into it, you've got all that expansion happening. It traded completely sideways. You were probably up money, and then you waited. This, and I don't have the data to go back and prove this, but I can tell you that drop in volatility could have completely erased your directional move in that pop that you got off of that earnings. Okay. So being long calls through an earnings, you could see yourself be directionally right and still lose money in that instance. Okay. So make sure, you have the right strategy for the right situation, and being long options. And I do a webinar on trading earnings. If you really like to trade earnings, I do webinars on that, strike location, duration, and all of that stuff. Check that out, because you'll avoid the pitfalls that Goldman Sachs is going to be going out there and giving you information about. Sometimes those guys on TV are giving you free trading advice. It's worth just that. They're usually the guys on, I can't say all of them, but I had a customer when I worked on the floor. I used to trade and have a brokerage business. I had a customer one time go on CNBC, and we had a TV, and I'm literally watching this gentleman talk about where he thought interest rates were going. All right. And basically he was saying interest rates were going to go higher, which means that futures should go down, right? It's a teeter-totter. Interest rates are inversely correlated to the bond prices. So he was saying interest rates are going to go higher, so bond prices should go down, which means you should short the futures, right? This guy had a bid in the pit to buy futures. He basically told the entire world to go out there and sell futures right into his lap. He was just scooping them up. Just keep buying. Because literally, he thought it was actually interest rates were going to go down and that price should go up. So keep that in mind as well. Make your own assumptions and analysis. It's probably right. So what vehicle do we use? The long call. We're looking at the long call. We've got that, right? Because we've talked about this with the duration. Let me go to my pen. The destination. The destination is that underlying, right? It's the underlying. It's the stock, all right? So with that being said, we want a tight bid ask. Tight, that's not very well written. Tight bid to offer, however you want to say bid ask is what we used to always say. All right, so the destination, that's our underlying. That's where we want to go. We want to get to that point. The environment, that's what we were talking about. That's vol. I'm just going to write vol. It doesn't mean volume. It means volatility. And we want that to be equal to low volatility, right? So we want low volatility, or we have we have low volatility, is I guess. We have low IV percent. All right, our duration, remember, we're buying volatility, we're buying cheap premium. We don't want theta. We want to avoid theta or time. So this is the time, the duration. We want to go further out in time. So basically, we want to probably go greater than 50 days to expiration, all right? Over that 45 days, because remember, that's where that starts to spike. And then our strikes. This is something you are also going to find on online. We're going to basically look at the 45 to 35 delta option, all right? And why are we looking at that 45 to 35 delta option? Well, another thing with delta is we talked about how it affects the premium for every dollar move, but this delta, you know, on a standard deviation curve, we've got this, right? And these are the calls and these are the put side. So this is negative. So basically you have your, this is a +1 standard deviation. This is a -1 standard deviation. Well, the idea here is 68% of the time is going to kind of fall within these two areas. And the 1 standard deviation move is actually a 1 delta, which is equal to about, it's right around, let's say, a 36% chance that the market will end up out here, all right? So the idea is we want to kind of pick that delta where we have a high probability, and we would say that this is about the 45 delta, all right? So we've got a 45% chance of being in the money. And you might be saying, hey, Wolfman, those aren't very good probabilities. I've got less than a coin toss probability of that happening. Well, a floor trader hack here is on the delta is that 2 times delta is the probability, is your percent chance of being kissed, all right, or probably your chances of getting touched. So the idea is during the duration, during that next 70 days that we're looking at in this IBM trade, during those next 70 days, yes, on 73 days from now, the expiration date, all right, the day those options expire, there's only a 45% chance of being in the money by 1 penny, all right? But during that next 70 some days, the probability is about 80% that the market's going to come up there and hit that strike, all right? So if it comes up and hits that strike, then I'm going to be at the point where I want to exit anyway, according to my guidelines, according to my roadmap, all right? And I have specific guidelines on that, which I'm glad you guys are sticking around because I'm getting a little long-winded here. All right, so, and we'll talk about that with the exit strategy. All right, so our max profit is unlimited with this. We need to talk about that. Our max loss is the premium paid. Remember, that's the beauty in buying options. When you buy an option, you immediately know what your risk parameter is, right? And that's the premium you paid. You can't lose any more than that. And our break even is that long option plus the premium we paid. So when we go over and look at, sorry, I got a tickle in my throat. All right, so for instance, we're looking at like this 36 delta, which is what I was talking about, 78 days. I want to get outside of that wheelhouse, right? Let's just go through the process here. I'm IBM, and if you guys watch the daily market commentary, I'm just looking for a way to get into IBM, and I think it's going to go higher. So I have a bullish assumption in IBM. So IBM, is it a tradable option? I go over here, move the decimal, 13 cents. During open market operations, I can tell you that generally speaking, it is within that 13 cents area. Excuse me. And I'm going to look at it like, okay, maybe it's a yellow light. All right, I looked at that. Now I'm looking at implied volatility percent. It's below that 50. It's a pretty low implied volatility. I know these premiums are pretty cheap. Now I'm looking at the 45 to 35 delta. I'm probably going to, you could go over and look at the chart. However, you're going to look at getting into it. The way I was looking at it was, I don't want that. The way I was looking at this when I was going through this earlier today is 34.33, right? That's basically 35. That's what I'm kind of looking at. I think that it's going to go up to at least 35. That's where I'm looking for that market to want to go to, right? So I'm going to pick a little bit further out on the delta and go with that. Try and get it to come up and kiss that, limit some of the risk of being wrong or trading sideways going into that. Plus, it does have an earnings coming up, and I probably should be able to do well from that expansion and volatility as we get closer to that earnings event. So what we're talking about is if I buy this option, all right, and we're looking at this here, I'm buying it for $4, let's say, or a little bit less, $3.90. My break even is the option strike, that long option, plus the premium. So, it says that my break even is at 138.90. Do I have to get to basically, 139 to break even on this trade? No. That's why we've gotten further duration. That's at expiration, okay? At expiration, I would have to, on August 21st, I need to be at 139 to be at break even, all right? Or August 21st. At August 21st, which is when this option expires, I need to be at 139, what did I say? 130, let's just call it 139, 138 something, 138.90, 139. I need to be at 139 to be at break even on August 21st. Now, we're going to be out of that as soon as I see this increase by about 50%. So that means it goes from $4 and now it's trading $6. All right, that would be my exit, an increase of that 50% on this premium. Now, if I get that move higher by another $6 or so, right? If I get a $6 move higher, well, we can look at what is delta. I'm not even going to add in gamma on the second dollar. We're talking $6 move higher. And the delta is going to increase quite dramatically on $6. So let's just call it, I get a $6 move, so 6 times, and I'm just going to say 40 cents to kind of add in a little gamma here and there. So 6 times 40 cents is going to be very close to where I was talking about, right? I'm going to buy it for $4. I get that move. I come up and it kisses my 135 strike, right? I've got a 70% chance of that happening because 2 times the delta is the probability of it coming up in the next 70 days and trading 135. All right. We're not even talking about the expansion of volatility right here. I just get the expansion of volatility by, 10 percentage points, right? If I just got an expansion of volatility by 10 percentage points, that's going to increase it by that $2 that I'm looking for anyway. So an increase of 50%. So I buy it for $4. I'm getting out for $6. So that market comes up and hits that 135. I know that I'm probably very close to achieving that profit potential, right? So that, for me, when we're looking at an exit strategy on this, which we need to look at, right? So this is our a road sign. We're looking for IBM, and I'm saying, 135. That's where I'm looking to be a winner. That's where I'm going to exit. I'm exit IBM at 135, right? So know your exit. On the loss, this is a bit of a gray area. So on a loss, however you get into trades or you put your stops, I see a bunch of questions coming up. I'm just trying to get through this real quick, and then I will get to you guys, I promise you. So on a loss, for instance, I get into this. Where's your stop? Okay. The market breaks below 120. You're like normally put a stop in there or something like that. That's where I would get out. Okay. For me, usually with options, I will pick that line. You guys saw it on TLT today. My TLT trade went against me and it broke below my area where I wanted to get out. And I got out. It didn't go down there and even hit my strike or any of that stuff, but I got into it based on a specific parameter. I thought it was going to stay within this range. Once it broke out of that, I covered it. So the same idea goes here. If it breaks down below, you're looking to get out. Just like I said, hey, if IBM comes up there to 135, I'm out of it. That fits with this rule that my 50% increase in premium, that's what we're looking for there. I'm out at 135. On the downside, I would probably say, you know, my risk is a little bit more than your guys's, but I would say that, you know, if IBM started breaking down below this area, I'm out. You know, some of you might be like, hey, Wolfman, why don't you just do it on that Fibonacci? That's fine. You know, however you're normally thinking about getting in and out of these, you could do that. Because you're buying it and you know your risk parameters on this, and your probabilities are pretty good that it's going to go up there. You know, some of you might just put it on and forget about it, okay, until you achieve that. It's kind of like I'm either going to make it or not make it, okay? But I don't want to tell you, you know, I don't want to change how your assumption works, okay? That's something I'm not here to do. I don't want to. If you guys, you know, Fibonacci's work well with you. If you're looking at the 250 or the 50 simple moving average and it breaks below that, or the 9-day because you're looking at a shorter term trend, okay, then I don't want to change that. You know, maybe you'd say if it broke below the 9-day simple moving average, you're out, okay? You can do that as well, all right? I don't want to influence those type of things. So this is where you're going to need to do a little soul searching on your own for your exit on a loser, is where you're, because I don't know your risk parameters, right? I don't know how much risk you guys are willing to take. I am more of a risk taker and willing to take on more risk. So it's hard for me to say, you know, this is a great exit on this, all right? It's a little bit more difficult for me to say. On the upside, the probabilities I can speak to, right? I can say you've beaten the probabilities if it goes up to 135. You got a 70% chance of that happening and a 35% chance of it being in the money at expiration. What probabilities do you want? I want the 70%. All right. So that to me is logical, right? On the downside, what type of risk you're willing to take on that loser is a little bit more difficult, and that's going to be something for you guys to come up with. You know, on a loser, you could say I lose 50% of the value of my premiums. That's, you know, I paid $4. It starts trading $2. I'm out. I'm just pulling the ripcord on it. Okay, so that definitely can work as well. So many questions are coming up. I'm losing track of the first one. So hold on a second, you guys. No, don't hold on. Don't stop asking your questions. So your loss, that's a little bit of a gray area for you guys. On the winner, though, we're looking for a 50% increase in the premium. All right, 50% increase in that premium. And that's, you know, if you're only paying 30 cents and it goes to 60 cents, that's actually a pretty good winner. Some of you might be talking about that. So let me go back a little bit. I got to scroll here for a second. Love the details. Thank you. Not long-winded, Eric. This is great. Appreciate that. When we expect volatility to go up, can you expand on that a little bit more, Abmas? Regarding expiration date, would you still choose 50 days to expiration, even if you expect the price move in 10 days. Any drawbacks, penalties you're paying, planning or paying for choosing the 50 days. Yes, the volatility. I mean, we just saw that, 50 days, 43 days, that volatility coefficient is still going to be a little bit less. Yeah, you're going to be paying a little bit more for the premiums out there about 70 days. But, the volatility, remember, 1 percentage point increase was almost double that of even the theta decay over there. Okay, so I'm a little bit more willing to put up a little bit more money to get that volatility expansion. So that's why I choose out a little bit further than even 50 days. I want to. The 50 days is like it's just not that. It's just too close to that theta component starting to ramp up, and we start losing our volatility coefficient a little bit. Remember, volatility affects further duration. Does Eric offer one-on-one coaching or mentoring? We will get to that. I do have a program that we're going to be talking about. Yes, I do, where I have a no inbox policy. If you guys are reaching out to me, I'm making sure that you guys understand. I can't tell you exactly what I think you should do, but what I can tell you is what my rules are, what my guidelines are, and what I would do. All right. So again, you have to sometimes do a little bit of soul searching. Know your risk profile. How much risk am I willing to take, and go for that. Is there a quick hack to see whether or not the chances of touching is related to the percent profit gain that you would like? Well, they kind of go hand in hand, to be quite honest. So, I'm usually picking those deltas and stuff like that. And those deltas have a tendency to correlate very closely to that. We get that double move, it's going to be very close to, especially that 2 times the, or 50% increase in that 50% increase in that premium. Okay. Are the stops usually the stock price on the option price? The stop, are the stops, okay, I did read that right. So with this underlying, with this type of strategy, you can look at it like you paid that premium, and you can't lose any more than that, so you don't have to worry about it if you get that directional move, especially if the directional move goes against you almost immediately, and you're all of a sudden like, okay, it's only worth 50 cents now, or maybe $1. Well, at that point, I would probably be like, you know what, I'm just gonna, and it's me. I have a high risk tolerance, right? If it went from $4 to, $1 or, $1.50 in the next 2 or 3 days, I'd probably be like, you know what, at this point, I'm going to ride it out. I still know my probabilities when I put this strategy on was a 70% chance of it going up there. I'm going to stick it out. Now, if your gut feeling, now, one of the things I didn't mention, when I went to college, I started college with a psychology degree. I wanted to go in and like pick people's brains, I guess. And I started trading, and then decided to switch it over to finance. So I always say that my psychology degree actually influences my trading, or is a better influence on my trading probably than my financial degree. Yes, I can go and look at the economic data and all of that stuff and come up with all these reasons why I think something, but the bottom line is if your gut is telling you something. So for instance, all of a sudden IBM does something funny and starts going against you, or XYZ does that, and your gut's telling you something like, maybe I should get out of this now. That's when you should get out. It's your limbic brain. It's the part of your brain that doesn't have a voice. It doesn't have the voice to say, dummy, get out of this trade because of all of this. It processes so much information in your limbic, but it doesn't have a voice. All it can do is really give you that feeling of uncertainty, or it's like the devil and the angel. You can always talk yourselves into believing one or the other, but whatever the gut is telling you is the right one. So keep that in mind. So, you know, if your gut's telling you to get out, even on a winner, like you got a big spike higher and all of a sudden you're like, I don't know, maybe I should get out of this. Yeah, you probably should get out of this. All right. This was a great webinar. Thank you. Will you automatically send us a link to the recording, or do we have to request it? We should be sending out a recording. It does take a little while to get that out, maybe a day or something like that, especially, you know, our friend Patricia lost her dog today, and she's the one that usually sends these out. So it might be a little bit delayed, just so you know. So, but yes, if you don't get it within the next day or so, you can reach out to us, and you should get a recording. And like I said at the beginning, watch it again, because especially if you're newer to trading, it will help some of this sink in. If you're a little bit confused with how I kind of did this, and I'm shooting from the hip here, you guys, because this is a brand new course and set up with the roadmap. You can go back and watch some of my other ones. Eric, can you do another webinar on covered calls? And yes, Prasad, I have done on covered calls. As a matter of fact, I just got done with implementation of options into our portfolio. So it's kind of based on the idea that we have some option, or we have some underlyings in our portfolio, whether it's in a 401k or an IRA and stuff like that. You know, we are longer term, how we manage that, stay mechanical with that portfolio of stocks we already have. So yes, I just did a course on implementation of options. That's a great one, especially if you have a portfolio of stocks there as well. Thank you, very nice information. Thank you, Alexander. All right, so I'm going to throw a link over there in the chat window, you guys. Click on that right now so that you guys can see what the offer is. It's this right here, which if you're watching it on tape delay, it is our options lab, okay? And this is the link as well, the HTTPS, Pro Trader Strategy, Wolfman Option Lab. You guys are going to get full access to my entire Option Lab courses. That's over 100 hours of video content there. And if you guys have clicked on that link that I've added over to there to the chat window, it should pull up a web page for you that you can scroll down. You know, I usually put screenshots on it, but there's so much content on there that it was like literally I was going to have like 6 pages of this. So I decided to go with this. Make sure you click on that so you can follow along here. Also, the first 100 members, you guys are going to become the first charter members of this options lab. So you guys will have that to hang on your hat there. Also, you'll receive upgraded VIP option lab membership status, which means you'll get access to those future content, promotions, discounts, all of the VIP informations in Wolfman Option Lab events. You also have question and answer office hour sessions, which is what I think Prasad, am I saying that right, Prasad? That you'll have access to me. And like I said, you know, I have one guy that's basically over in Japan, and I'm trying to work with him on his hours and our hours to make sure that that he's taken care of as well. So it doesn't matter where you guys are. I'm going to be trying to make some time for you. And like I said, I have a no inbox policy. I'm trying to make sure I answer everybody, and that's why we're kind of limiting those hundreds, because you guys. It's a lot of work, and I'm happy to do it, because if there are better traders out there, we all create better markets, right? You and I may not have the same market assumption, and therefore we create better markets. And that's really what it's all about, is if we can all create better markets, then, you know, it's better for everybody. So you get full access to that for $97 a month. I suggest you guys take advantage of that, especially if what I'm doing is clicking with you, you know. I talked about, yeah, you can get free information online or on TV and stuff like that, but they aren't going to break this down into the nuances of strike location and volatility and how we need to set these up according to some of these rules. All right. So, like I said, I've been doing this since the 80s, basically, and trading options, you know, and I had to learn on my own for a while there. And it was, started out, Prasad, doing covered calls on stocks that I had bought. I worked since I was basically 12 years old on a farm, and all the way from detasseling and driving a tractor and shoveling horse manure. So I saved that money up, and when I went to college, I basically dumped it into a bank account, and the guy at the bank was like, dude, you aren't going to spend all this right away. You want to invest some of this into some stocks? And I did. I bought IBM, and I bought Walmart, and I bought another one, which I didn't really trade options around, but IBM and Walmart, I traded options around after a while because they were just trading sideways. It was like I was watching IBM go up to just above 100, and then it would go back below 100, and then it would go above 100, and then it would go below 100. And it was basically, I was just like pulling my hair out. My stock isn't going anywhere. And then this guy started talking about selling calls, doing covered calls. And I started doing that and getting into the options and all of that stuff. So that's how that all progressed. So take advantage of this. Like I said, it's over there in the chat window. If you're watching this on tape delay, you're going to have to punch this into your URL. But you can see there, you guys, if you pulled that up, there is like four, you're going to have to scroll down like 4 windows of these types of screens. And it has all those things in there also. Prasad and everybody else that's been asking that there's some covered call courses in there that you can look at, some earnings trade courses in there that we've talked about, I believe, and all of those things. So you don't have to watch the long call one like this again. Watch that long call one maybe that I just did for implementation of options into your portfolio, okay? And very similar in nature, all right? So without further ado, I do want to thank you guys all for attending this. Later webinars, I'll drill down on different option components when and where I find those appropriate. Also, here is the same link that you can punch into your URL if you're watching this on tape delay. Chat window's got the real one. Thank you guys for watching. If you have any questions, reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. Especially if you guys see some content or you want to see some content I haven't covered, reach out to us. Make sure you get that. Also, yes, this is the disclaimer. There is risk of losing money, and we are an educational company. We're trying to teach you guys how to swim. I'm not here to swim for you. I don't give trade recommendations. I can just tell you what I'm doing, and it's up to you guys to be big boys and girls out there, all right? So take a minute to go over that. That's all I got for you. Other than, if you can't take that, take it easy. All right. Thank you guys all for the kind words. I do appreciate it. Bye for now.